Hello, this is Professor Chandana Goswami, and today we will discuss about raising long-term finance with special focus on venture capital and private equity. So what is a venture capital? It is the capital that is invested in a project in which there is a substantial element of risk. So which means typically it has to be a new or expanding business where you are making the investment. Startup companies with a potential to grow need a certain amount of investment. On the other hand, wealthy investors like to invest their capital in such businesses with a long-term growth perspective. And this capital is known as venture capital, and the investors are called venture capitalists. Such investments are risky as they are illiquid, but are capable of giving impressive returns if invested in the right venture. We are calling them illiquid because there is no market for trading of this investment. The returns to the venture capitalists depend upon the growth of the company where they have invested. And because they have invested and it is their money at stake, so venture capitalists have the power to influence major decisions of the companies where they are investing. This is an article and I suggest that you go through it. It is in the Harvard Business Review and the details are given out here. So who seeks venture capital? Normally it is a young company that is unable to tap the financial market due to regulatory constraints. If you have gone through my video on IPO, you will have now understood that in order to raise money from the capital market, there are certain regulations that have to be complied with. And a young company may not be in that position. And it is also unable to borrow. Why? Because banks are not comfortable funding new untested business. So if banks do not finance, why should a venture capitalist finance? So these are the reasons. Although the business is risky, it has the probability of earning high rate of return. And so the venture capitalist buys equity in the company. The investment is done to help the business grow in size and credibility so that it can go for IPO in the shortest possible time. And it is in this point of time that the venture capitalist can sell his shares and exit with profits. These are some of the venture capitalists in India. We have ICICI Ventures, Accel Partners, Sequoia Capital, Nexus Venture Partners, Kalari Capital, Bloom Ventures, and there are many more. There are also foreign VCs in the market, and foreign investors brought in lessons learned from other developing and emerging markets. They introduced the following in their transactions. Number 1, rigorous due diligence. Number 2, tight contracting. Number 3, active post-financing involvement. Number 4, sharp focus on timely and profitable exit. I am sharing a few things from the India Venture Capital Report 2020, and this report is available at www.bain.com. So the authors Arpan Seth, Srivatsan Krishnan and Samyukta T have given these perspectives. Even in the face of global economic uncertainty, 2019 was the second most active year globally for venture capital investments in dollar value. It was a milestone year for the Indian VC industry too, with $10 billion in capital deployed, the highest ever, and about 55% higher than 2018. Additionally, India witnessed a 30% increase in deal volume over 2018, as well as larger average deal sizes across all stages. Despite substantial capital deployment, dry powder availability for VC investing in India was at an all-time high of $7 billion at the end of 2019, indicating likely continued investment activity in 2020. Please keep in mind that this report was published on 2nd March 2020, and when the report was written, I am sure none of us knew that a pandemic was around the corner. So the report further says, the Indian VC industry passed through three distinct phases over the past decade. Between 2011 and 2015, the industry experienced rapid activity growth, to support an evolving startup environment. During this phase, multiple VCs entered and became active participants in India's economy for the first time. This initial, almost euphoric phase was then followed by moderation between 2015 and 2017. The lack of clarity regarding exits made investors more cautious, and that shifted the focus to fewer and higher quality investments. Over the past 2 years, however, the VC industry in India has been in a renewed growth phase, buoyed by marquee exits for investors such as Flipkart, MakeMyTrip, and Oyo, strong startup activity in new sectors such as fintech and SaaS, that is software as a service, and also market depth in e-commerce. About 80% of VC investments in 2019 were concentrated in four sectors: consumer tech, software, fintech, and business-to-business commerce and tech. Consumer tech continues to be the largest sector, accounting for approximately 35% of total investments, with several scale deals exceeding $150 million. Within consumer tech, verticalized e-commerce companies continued to be the largest subsegment, but in addition, there were increased investments in healthcare tech, food tech, and education tech. Both SaaS and fintech attracted significant investor interest and activity throughout 2019, with several early stage and increasingly late stage deals. Meanwhile, the Indian government introduced several regulatory programs to boost the Indian startup ecosystem. Flagship programs such as Startup India, Digital India, and the Alternative Investment Policy Advisory Committee continue to improve the economic landscape for startups and investors. India's ranking on the World Bank's Ease of Doing Business Index also increased significantly from 130 in 2016 to 63 in 2019, improving investor confidence in the regulatory ecosystem. Some of the features of VC. VCs are inclined to assume higher degree of risk in expectation of earning a high rate of return. They normally subscribe to equity or quasi-equity financing instruments. Quasi-equity means almost like equity, and normally they are unsecured loans with flexible repayment options. They take active interest in guiding the firm and normally plan to liquidate investments in the assisted firm after 3 to 7 years. Private equity, how do they function? They invest in companies that are unable to raise capital from the public. Institutions or high net worth individuals contribute to private equity fund, which is then invested in business. Private equity fund invests in the later stage operations, that is, in companies that have a substantial operating history. Private equity actively oversee the investee companies. The investment may be used for financial or operational restructuring of the investee company. PE has provisions for debt, which is rare in case of a VC. Some of the private equity firms in India are Oaks Asset Management, ICICI Venture, Tata Capital, Samara Capital. So now that we have understood about a VC and a PE, our question is that how do I attract a VC or a PE to come and invest in my business? And these are the points that have been taken from yfsmagazine.com. Much of your ability to acquire financial backing will come down to the effectiveness of your business plan. So therefore, develop a practical adaptable plan which takes into account potential stumbling blocks and market shifts. Factor in potential challenges such as rising interest rates, non-payment by debtors, electricity cuts, theft of delivery vehicles, declining product demand, seasonal variations in supply and demand, and so on. Ultimately, financiers will look not only at your big idea, but also your ability to sustain it. They are looking for a solid sales track record. This doesn't just mean more money. It means giving your prospective investor something to measure return on investment against. If you can manage a solid growing flow of sales, then VCs feel a lot more secure about your ability to manage and nurture their seed capital. So with this I conclude. Thank you very much for tuning in.